CPI month over month coming in a touch soft. The survey indicating 0.2% growth. It actually came in at 0.1% year over year, bang in line with estimates, coming in at 2.4%. CPI ex food and energy year over year also coming in just a tick below the survey number, coming in at 2.8%. That is below the indicated survey number of 2.9%. Also want to get you the CPI core index coming in just a bit soft as well. And again, we have CPI ex food and energy month over month. That's actually the softest number, coming in at 0.1%. That is below the survey data of 0.3% and also below the prior month's reading, which came in at 0.2%. Taking a look at futures moving to the upside firmly off the back of this print, perhaps indicating a slower inflation picture than we had thought given tariff policy.
Yeah, fractional gains for the U.S. major averages. A few of the indexes that I like to keep track and tabs on here. The food index specifically, near and dear to a lot of people's stomachs out there. Food index increased 0.3% as both of its major components, the index for food at home and the index for food away from home. So those of you still getting those margarita deals at TGI Fridays, you're still going out there in full force here. That rose by about 0.3% though in May. In contrast, you actually saw the energy index decline 1%. We've heard a lot of economists kind of lean into where we've seen some retreat in the price of gasoline. That gasoline index fell over the month as well here. So that was noteworthy here. You also did see a few of the areas here, the indexes for airline fares, used cars, trucks, new vehicles, and apparel among the indexes that decreased in May as well. So a lot to keep tabs on there, especially within the retail landscape. Yeah,
and something I think that will be interesting to talk to our guests about is that there was this concern about goods leading to a big uptick given tariff policy, but we actually saw the index for shelter rising 0.3%. That was the primary factor in the all items monthly increase. So we have a soft inflation print driven by shelter as opposed to goods inflation as well.
Spot on.
Of course, CPI inflation rose at a lower rate than anticipated in May. Joining us for a category breakdown, our very own Alexandra Canal. Allie, what are you seeing?
Hey, Maddie. Well, what stood out to me was that we saw the monthly all items increase along with the core monthly CPI coming in below economist expectations here. And a big reason for that was that a lot of economists thought that we were going to see some of that early tariff impact. So, for example, we saw declines in car prices, apparel prices. These were categories that were expected to rise thanks to Trump's tariffs, but we did not necessarily see that this month, and that helped drive the cooler than expected core CPI reading. You saw declines in energy, for example. That was helped by gas prices, which fell about 12% on a yearly basis. However, there are some categories that remain sticky. Food, for example, rising 2.9% on a yearly basis. Shelter still up 3.9%. We saw rent and owner's equivalent rent, which is the hypothetical rent you would pay for that same property, also rising to the upside. Lodging away from home, though, did see some easing, falling about 0.1% here. Now, egg prices, that's something we often talk about here. That was down 2.7%. Actually, I believe it was up 2.7% on a yearly basis, but my bad, down 2.7%. I have a lot of numbers here, but they still remain near historic levels. So even though we're seeing some falling categories, some falling items, that still doesn't mean we're out of the woods yet when it comes to the consumer story and what they're ultimately paying for. But hopefully with this truce that we just got between the U.S. and China, some of that impact is a little more muted.
Yeah, I was going to say, my eggs better be down 2.7%.
Otherwise,
my receipts
usually
are off.
it's on the upside. So I was like, I said that at first, and I said, are we actually down? But yes, we're down, which is encouraging, especially considering all of the risks that we continuously hear about these price increases.
Allie, thank you so much. To break down this inflation print, we've got Joe Brusuelas, RSM chief economist, and Claudia Sahm, who is the New Century Advisors chief economist and former Federal Reserve Board economist. Great to have both of you here with us. Joe, I want to begin with you and just get your initial takeaways. We were reading through some of your blog posts this morning, so I wonder how much of it kind of mirrors to your expectations coming into the print.
The big surprise was the large decline in energy at 1% and a really large decline of 2.6% in overall prices in gasoline. We're not really seeing much of the pass-through, if some at all, from the tariffs. Most importantly, we saw a decline of 0.3% new vehicles and 0.5% used cars and trucks. So that really did provide the much softer print than I expected or many analysts. So that's really, I think, the primary takeaway right now. But don't get too comfortable. When you hike prices by 10 to 15%, it gets passed through eventually.
Well, Claudia, let's bring you into the conversation. Do you think this softness that may have been indicated by the headline numbers is to be believed?
I think it can very well be an accurate picture of where we are as of last month. It's not necessarily really telling us where we're headed by the end of this year. And that's a big question as to exactly how these tariff costs, which we know they're being collected, we see them in the Treasury statements, where are they going to go? Showing up in CPI is not the only place that they can go, but it's really too soon to be saying we're, clear path back to, 2% inflation.
So, Claudia, with that in mind, it seems like the prevailing thought in the markets, at least, is that the worst of the unknown in terms of some of the tariff negotiations and policy talks, that seems to be behind us. So what would that signal for the back half of this year, especially as we're waiting for some of those deals to net out, and how long the tariff overhang could start to bleed through in a more powerful sense into some of these numbers?
Right. Well, again, even with where the tariffs are right now, at the level they're at, which is much lower than some levels we had seen earlier this year, they're still 6 times what they were before we came into this year. We still have an adjustment. In the real world, adjustments take time, and businesses have took efforts, built up some inventories, tried to, slow things down. So again, I don't think we have a picture yet of what the costs really are from the current policy yet, even if that policy doesn't get any worse.
And Joe, it makes me wonder whether we, as investors, is Wall Street sort of past the point of being too concerned about tariff policy? We're also having some tariff headlines crossing this morning. The president saying the deal with China is done, but we saw futures hitting session highs off the back of the inflation data. Is the market back to focusing on the inflation data primarily?
No, this is likely to add to the complacency in a market that's priced for perfection right now. My sense is when I look at this, I see some good things. Ex-food, energy, shelter, inflation was flat and is up 1.9%. This is a function of the really heavy lifting done by the Fed over the past several years. However, again, when your effective tariff rate is over 15%, you're going to see some pass-throughs. It's just a matter of time. When I look at the inflation report this morning, I see on a year-ago basis, services are up 3.7%, housing's up 4%, and shelter's up 3.9%. We're back within ranges that I think are tolerable, but I'm not expecting much improvement in those indices. Again, what I'm really worried about is going forward is the impact on goods prices. More importantly, the impact on food prices. Notice that food prices were up, and we know the Federal Reserve is now beginning to take a much closer look at food prices and near-term increasing of pass-through from these tariffs. And I think that's something that we all want to focus on, given where what the market wants, which is rate cuts, and what the Fed's likely to do, which is not give them those rate cuts. At this point, we'll be lucky if we get one this year, perhaps in December, should we really see inflation become transitory, and it's just too early to make that call.
It's interesting, especially as we are, to Maddie's point, getting some of those officials that are talking about Trump set it to hold new China tariffs at 30%, according to one official here. As we're thinking through what Torsten Slok over at Apollo, and this just hit my inbox this morning, his outlook for China, consensus predicts a decline in China's growth from its current rate of around 5% to 4% next year. What's the knock-on effect if we do see that hit on their current growth rate in China and some of the U.S. dependency as well that relies on those purchases, those larger contracts as well, Joe?
Well, China's got economic problems beyond the trade war. They've been adjusting due to a significant issue inside their housing and financial sector, and I would expect Chinese growth to slow. Moreover, China's overproducing and attempting to flood the entire zone, that's the entire global economy, with excess production. So they are going to be exporting some deflation. Now, if that were the case in the United States, sure, we'd be talking about something different, but I don't think that's going to be the case. Right now, the effective tariff rate on Chinese goods is above 40%. And by the way, before I finish answering this question, I want to say, what the best news is here this morning? I see my friend Claudia on camera, smiling, happy, and healthy. I hope you're doing well, Claudia. It's good to see you.
Yeah, thank you.
That is amazing news. And Claudia, we are so happy every time you join us. So thank you for making the time this morning. But I do want to get your insights before we let you go, because one of the things I'm also interested in here is that inflation is cooling. The labor market, it's decelerating, but we're not seeing anything crazy yet. Are we back to the soft landing question? Is that what this looks like to you?
It's just not the conversation yet. I mean, it's really good to see inflation, be stable this month and not pick up, right? So, but we know there is a disruption. We know these costs are going to get passed through. We're just not at that place to having the conversation of the soft landing. And in some ways, the good news today, it probably delays that conversation. It delays the Fed's ability to say, oh, okay, this is temporary. We can look through this. Now we can get back to cutting rates. It's just going to take some time for this to work its way through.
So should we take 50 basis points in cuts, which is what the market's pricing in through the end of the year? Should we take that off the table, Claudia?
I don't think we necessarily take it off the table. It's timing is tough. Right? We're still in a world, and I think today's data reinforces this. We are in a world where the next cut or the next move is likely a cut, right? So then it's a question just with the calendar and the timing and how long does it take for this to work its way through? In some ways, if we have a gradual adjustment to multiple large policy changes this year, if we do it gradually through the economy, that's probably the least pain path. It may mean we delay the rate cuts some, but that may be the price worth paying here.
Claudia, Joe, great to see you both here this morning. Thanks so much for taking the time.
Great.
Thank you.
May CPI data showing inflation rising at a slower pace, up 0.1% month over month and 2.4% year over year. Joining us now, we've got Colin Martin, who's the Schwab Center for Financial Research fixed income strategist. Good to have you here with us in studio, Colin.
Yeah, thank you so much for having me.
What does this mean for the bond market from what you've been able to read through and assess in this report?
In a vacuum, this means that maybe we get the rate cuts that we've all been waiting for. If we
At what point?
Still later this year.
Okay.
Now, we never put too much weight on one specific report, but this is a string of months of pretty good reports, specifically with the CPI. The Fed favors more the PCE, but we can't deny that this was a pretty good report on a headline and a core basis at 0.1% increase, coming in below expectations. When we look at the inflation data, we like to break it out between the services category and the goods category because they can show very different things. If we look at goods, that's where the concern about tariffs come into play, but they came in better than expected. I think there's probably a lot of moving parts there. The idea that maybe companies imported early and they still haven't decided how much they want to pass through because they still don't know. I mean, you just talked about the idea of Trump and Xi and will they, won't they, what is the rate going to be? We don't know what it's going to be. So I think companies might be a little bit hesitant to push those through. But if we look at the services side of the equation, we saw that come down a little bit also. That's good from an inflation front, not necessarily good from an economic outlook front. Because if we're seeing airfares down, international tourism down, things that we as consumers are spending on, if it's because we're spending on those less, that's not necessarily a good thing. As it relates to the Fed, yes, maybe it pulls forward the timeline, but we haven't really changed our view just because of this one release. We still think 1 or 2 cuts this year. September is probably the earliest at this stage. We'll see how the next few months play out.
It's interesting because we did see, to your point, services cooling, but also goods cooling, especially in categories like apparel, cars, new vehicles, areas where you would expect, tariff impact to show up. So to what degree does the bond market indicate to us whether or not to believe the cooling narrative in this print versus a narrative that's potentially just not baked in the tariff policy impact?
I'd say right now the market believes it because we did see a relatively sharp decline in yields across the board, whether it's 2-year, which is very dependent on monetary policy in the here and now, but also the 10-year, which looks ahead at what should we expect over the next 10 years. But we take all of these with a grain of salt. I mean, every release is scrutinized so heavily, and if we were to get something that says, hey, maybe this trend is actually reversing a little bit, we'd probably see that play out in the bond markets right now. So our main outlook is volatility. We think short-term yields will probably continue to drift a little bit lower with some ups and downs. We think long-term yields will probably stay sticky. There's a lot of forces that are keeping them kind of elevated, even if we get those expected rate cuts.
This was also a big week in terms of sensing where the demand is, especially with regard to the bond auction taking place. What most notably are you watching for there?
I think today's 10-year auction is going to be really important. We have a 30-year tomorrow. I focus more on the 10-year. The 30-year, who's investing in 30-year treasuries? I mean, I'm not. Most individual investors
If we're optimistic about the long-term prospects for the economy, then that's where, and the investments that have certainly been touted, whether internationally or from company perspective, that's where it would seemingly have more interest on the 30-year side.
That's right. It is sort of a vote of confidence, right? Yeah. I focus on it, of course, but we talk to a lot of individual investors, and the 30-year makes all these headlines. Obviously, you get large price swings. If that scares you, don't own a 30-year treasury. That's kind of what we tell investors. But yes, it is going to be important because for the past 2 months now, there's all these headlines about foreign investors potentially selling our treasuries. We don't know yet because we get such a delay. But it will be important to look at, the breakdown at the auction. One, is it a success generally speaking? But what does that indirect bidder look like? Are foreign investors buying more or less in terms of that vote of confidence? We're not worried that the vote of confidence is going to go away anytime soon. Mm-hmm. We still think the US dollar should remain the reserve currency. It doesn't mean it can't decline a little bit from here. Yeah. I think US Treasuries, despite the recent downgrade, our perceived safety of a US Treasury hasn't changed. But at the margin, if we do see some tweaks here and there, that could result in more volatility. If it's a weak auction, it could result in slightly higher long-term yields, which could spook investors a little bit. So it will be important to see who's buying and how much are they buying.
Colin, thank you so much. Really appreciate you making the time and giving us your insights.
Thanks for having me.